What is up, guys? It's Tyler, your bro host here from the BroCo podcast. Today, I'm going to be talking about a very special topic. So hopefully everybody can see the screen here. So we're going to be talking about what a 1099 versus a W-2 employee is. Take a deep dive into that and what that kind of means for you, and especially this year and last year. I'm a tax pro, so work with a lot of people, and we've seen a lot of people end up owing, and they did change laws recently, so we're going to be talking about that as well. So something kind of important to talk about when we're talking about 1099s and W-2s is that 1099s don't get any taxes withheld by the employer. They're paying them before tax money. On the other hand, as a W-2 employee, you know that you have Social Security, Medicare, federal taxes withheld. What you may not know is that you are actually only paying half of the Social Security and Medicare tax liability that you carry. Your half is 6.2%, and for Social Security and for Medicare, it's 1.45%. And then the employer pays those same amounts for your other half. But as a contractor, because it's before tax income, right, they pay federal income taxes in April, which is, your standard 12 to 28% of income. They pay Social Security and Medicare as well, but for Social Security, they pay 12.4%, and for Medicare, they pay 2.9%. With a 1099 independent contractor, you're considered self-employed, and that means you also must file a Schedule C with your tax return, which tends to make tax returns a little more pricey. And some people get really confused, like, well, why is it so much more expensive this year? Well, if you have a Schedule C on there, that's probably why. And that's understandable because there's a lot of work that goes into that. But first, we're going to talk about the W-4. So this is the paper that you fill out when you go to get a job. It determines how much money they withhold for your federal taxes. Social Security and Medicare are fixed at those percentage rates that we just talked about, so you don't have to worry about that. But your federal taxes can change depending on tax credits, income level, things like that. Generally, your average standard population, you're going to be somewhere between 12 and 22% tax liability. You fill out all your information at the top, and then it has some options there. You see single or married filing separately, married filing jointly, / qualifying surviving spouse, or head of household. Many of you probably know that those are your tax filing statuses. Keep in mind, whatever you select on the W-4 form does not have any impact on your tax return other than the taxes that they withhold. So if you're married, you don't technically have to mark married filing joint. You could mark single if you want them to withhold as if you were single. There's a spot where you can multiply the number of qualifying children under age 17 by 2,000. So that $2,000 is referring to the child tax credit. For every child, you get a non-refundable tax credit of $2,000 under the age of 17. If they're over the age of 17, then they get a $500 non-refundable tax credit instead of the $2,000. If you're single, you don't have any kids, you want to put 0. Always. There's no 1 anymore where you're claiming yourself, right? So there's no claiming one person as if I'm claiming myself as a dependent. There's not any of that anymore, and that confuses a lot of people, which is understandable because they used to be the case, but there's no claiming 1 anymore, unless you do in fact have a dependent that you're taking care of and you want a little bit less taxes withheld. Then you can put your $2,000 in there for 1 dependent, or $4,000 if you have 2. So if you have no dependents, leave it blank, 0. So then if we go down to the next section, it talks about other income not from jobs. So that's referring to like investment income. So if you have like stock accounts or interest income, that you have money coming in. But generally, I don't worry about that part. You can probably just leave that part blank unless you're making enough in dividends and interest to pay for your bills every month. If you're going to be itemizing, generally, most of us aren't going to be itemizing. Used to be that was the way to go. Now it's either the standard deduction or you itemize. If you don't have enough itemized deductions to get over the standard deduction, then you're not going to be itemizing. So generally, we don't have to worry about that section either. But this next part, the extra withholding, that's very important. And that's where we get to kind of the rule change there that I was kind of alluding to with the claiming dependents. So they changed the rules. Now, if you claim single zero, they're withholding as much tax as it takes to get you to zero tax liability. Great. So you won't owe any money, but the flip side is you won't get any money back either. The other thing to keep in mind is that, if you have additional income on top of that, then if you're at zero on your wages, then that's going to push you into the negative, right? So that extra withholding, generally, if you don't have dependents and you're looking to get a refund, you don't have any other tax credits, nothing like that, I generally say you can probably have them withhold an extra like $25 of your income each pay period, something that you won't miss a lot. And if you get paid on salary, you get paid once a month, then I would say $50, right? If you get paid weekly, dollars or whatever you want to call it. That's also kind of one of those things that we deal with as tax preparers. Not a lot of people know about this change. So, and the other thing is their employers didn't tell them about it either. And they had a W-4 that was already in. They kept it that way, right? So they're all of a sudden owing all this money. And there were so many people that owed money this year. So guys, if you aren't aware of your W-4 situation, please go talk to your HR people. They should be able to help you with this and help you update it. Like I was saying, if you have more than one job, that can also skew things, right? So the issue is, like, if I work at place A and I make $25,000 from place A and they withhold money as if that was the only income that I had, right? Because after a certain point, they start withholding taxes, and they start withholding it more aggressively as you get closer to the standard deduction. Because if you don't make it more than the standard deduction, there's no reason to withhold that much because you're not going to owe. So then, with that in mind, I made $25,000 at that place, and then at place B, I changed jobs. I made $10,000 at that place. Well, they're not withholding as much because I'm below the standard deduction. Right? For 2023, it was $12,950 for individuals. I'm under the standard deduction. They're not going to withhold that much taxes, but I had that $25,000 on top of it. And they withheld taxes on that, but only for the $25,000. So now you put it together, now you owe taxes on $10,000. And not only that, but sometimes you get pushed into a higher tax bracket, so you may owe a little bit of tax on that money that you've already had withheld at a certain other tax rate. So it's kind of a mess, and you don't want to get into all of that. So please, guys, utilize the W-4 having to pay taxes at the end of the year, because I know how it goes. You're not expecting it, you get hit. You're really gunning for that refund. You want to go on that vacation, you don't get it. Don't be that guy. Make sure you're keeping track of this stuff. Next thing, the W-2. This is pretty simple. And I just want to go over this so that when you get a W-2, you know what some of these things are and kind of understand what they mean. So the W-2 is what reports your gross income, your federal tax withheld, Medicare, Social Security tax withheld, and your state tax withheld. It also reports certain deductions, which is on line 12. You'll see there's a 12A, B, C, and D. This is because there can be multiple codes that you have. So an example of some codes would be like a letter D code in box 12A would signify a 401k contribution and then the amount that you contributed. And these are codes that help us determine what kind of credits you're eligible for, right? So 401k contribution, you could be eligible for a credit for retirement contribution. Code W is for HSA contributions. DD is health insurance. AA is Roth IRA contributions, and code C is a life insurance. And those are kind of like the most common ones that we see. That federal income tax withheld, that's how much taxes they withheld to cover your liability. So that's essentially like you paid that in already. You prepaid the liability. Whatever's left over, either you get refunded or you end up owing, depending on what direction you're in. So a way that you can kind of like calculate your tax liability when you get your W-2s, you take your gross income, which is going to be your total of all of your wages. So box 1 of all your W-2s, add all of that up, subtract the standard deduction for that year, which for 2023 it was $12,950. For 24, I think it's $13,850. Subtract that from the total gross income. Subtract tax credits that you might be getting. That's going to equal your taxable income. So that's the income that you're taxed on. If you multiply that by your tax rate, which is typically that 12 to 22%, it's probably safe to assume that you're about 15%. So if you multiply that, then that's going to be your tax liability. And if you take the tax liability and subtract the federal tax withheld, the total from all your W-2s, then you'll get your tax refund, or if it's negative, your tax owed. And that's an estimate. It's not perfect, but it's kind of a rough way for you to tell ahead of time and kind of prepare. Like if it's January, you get all your documents and you run that calculation, and you need some time. You wait until April. As long as you file it before the deadline, save up that money and pay off the liability. That's smart. So that's a little tool for you guys to use. This is an example of a W-2 with filled in numbers, so you can see wages, federal income tax withheld, code C. There's a code Q on there. I'm not familiar with that one. And then the state is Utah, how much they withheld. And then for our 1099 NEC, so it's really simple. A lot of times the 1099 NEC, there's either one or two numbers that are reported on it. So box 1 is non-employee compensation. That's basically like your gross income, right? Again, that's pre-tax. But now you have to take into account that you're also going to owe your Medicare and your Social Security taxes. You can use that same formula and just throw those in there, multiply the percentages by the gross income, and then you can estimate your estimated tax liability that way as well. But the kicker with the 1099 NEC is that they're not going to withhold any taxes for you. And then the only other number that might be reported on there is state income, but again, pre-tax. So you're going to owe the full amount of state taxes on that income. Every state's different. You can look that up if you want to estimate it. And then the last thing, I just kind of want to do a brief kind of overview of the Schedule C. So if you do end up with a 1099 NEC, the nice thing is, while it is pre-tax and you will end up probably owing taxes, you can deduct expenses to kind of curb some of that tax liability for a 1099 NEC because of the Schedule C requirement. Some examples of some expenses you can deduct. You can do auto expenses. So there's two options for the auto expenses. You can do mileage, where you keep track of the mileage that you drive. And there's certain limitations to that. You can't, deduct commuting or personal miles. But if you track your mileage, you can deduct that multiplied by the standard mileage rate, which they determine every year. I think this year was like 65.5 cents per mile. And then you can also deduct parking and toll fees on top of that. Or you can deduct your repairs and maintenance costs. So that's like repairs, oil changes, new tires, detailing, paint jobs, whatever. Most of the time, that's not going to be the better route to go. Usually you're going to go the mileage route, but keep in mind that it is an option to go the maintenance and repairs route. And then there is the option for a home office deduction. So if you work out of your home, then you can deduct a prorated amount of your mortgage or rent payments monthly based on the square footage of space that you're using up for your office in your home. And that also applies to your utilities. So you can deduct that same percentage of your utilities. And then there's meals. So you can deduct 50% of meals as long as they pertain to business activities. So that's kind of nice. Licensing and dues, if you pay licensing fees to maintain a license, or if you pay dues to an association, you can deduct that as long as it pertains to business activities. Your phone and internet bill, you can deduct that pro rata percentage as well if it's needed to perform the business activities. Tools and supplies, if you have any required tools or supplies to carry out business activities, you can deduct those as well. That same thing applies to uniforms and outfits. And then taxes and interest is kind of the last main one. There's a lot more, but I'll go more in depth in a later episode when we talk about business taxes. If you have like your own little sole proprietorship. Taxes and interest, if you're taking the auto expense deductions, you can deduct your vehicle taxes. You can also deduct auto loan interest if the auto is used exclusively for the business. I cannot stress that enough. You cannot deduct it unless it's exclusively for the business. And you can also deduct a pro rata percentage of mortgage interest paid if you're taking the home office deduction again. And then that also applies to your real estate taxes. The same percentage would apply. Let's talk about some examples real quick of some people who could get a 1099 NEC so you guys can be aware if you end up going into these fields for any reason, and you can kind of have a knowledge and understanding going in. DoorDash and Uber, those are 1099 NECs. That gets a lot of people every year. They do DoorDash on the side. Boom, they get a 1099 NEC. They pay a bunch of tax on it. It's something to think about. Certain construction jobs, if you're contracted for that, certain trade jobs as well. So plumbers and electricians, some of those guys get 1099. Insurance agents get 1099, and some real estate agents get 1099 as well. So those are some examples of some fields where that happens. But don't panic if you get one, because there are ways to curb the liability, and that's why we're making this episode for you. All right, and then kind of just to wrap up, and a quick little bonus here. An additional option if you do get 1099 NECs and if you don't have enough expenses to cover the taxes, you can make estimated tax payments, just kind of like withholding taxes, but you're making a payment every quarter, every 3 months to the IRS and to the state to essentially prepay the tax liability. That is an option as well. If you talk to your tax pro about it, they can help you out with that. But guys, tax planning is so important. Don't get stuck with a huge tax liability. It's 100% not worth it. And just do your research and make sure that you invest in a good tax pro that's knowledgeable and that has your best interests at heart. See you guys in the next episode.